Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management. Okay, hello everyone. Welcome back to another episode of Blind Spots. In today's episode, we are talking all about the retirement account positioning for retirees or those approaching retirement. So I saw an article in the Wall Street Journal this last week titled "America's Retirees Are Investing More Like 30-Year-Olds," and I thought it would be a nice conversation to have.
So I saw the same article, and Erin said something to me today. She's like, I saw an article in the Wall Street Journal, and I said, I bet I know what it is.
Great minds think alike.
And I was correct, but I couldn't read the article, so I'm kind of flying blind, but I can guess what it is saying and potentially some reasons why a retiree could be correctly or incorrectly investing slightly more aggressively than someone might think.
Yeah, and the correct asset allocation is never a black and white answer. I think we're kind of conditioned to think that the older you get, the more conservative you should be. And that is typically how it goes with your 401k and a target date fund, that you're just continuing to contribute to it. It's automated and will rebalance over time. But I think that it would be nice to bring it back to your most recent blog post, because I think that's relevant in this conversation about the 4% rule and income in a retiree's portfolio.
What you just said is a mental shortcut, and it's not the worst thing I've heard, but it's probably not optimal. So the old school mental shortcut is the older you get, the more conservative you should be. The younger you are, the more aggressive you should be. And again, I think that's okay, but I've met conservative young people, right? Like when I was coming up, I've said this before, I got my first job, bought my first house right around the great financial crisis. So that shaped the way that I viewed everything, right? I was a young person that was mindful of risk. I had been recently burned, so I'm mindful of risk. And then fast forward to my parents, like my dad, who's 71, the bulk of his career was in the late 80s and 90s. And those were great times to be an investor, great times to be a risk taker. So he tends to err on a more aggressive asset allocation because he's used to having the equity markets as a tailwind. So it's very specific, and oftentimes it's tied to something as simple as where you were born and when you were working.
Well, in addition to how past events shape the way that you feel about risk, I love the conversation that we have with people that have more than enough to live off of. They have more than enough that will last for generations to come. And you can make the argument both ways to be extremely conservative or extremely aggressive. So it's a fun conversation because everyone is so different.
Yeah, and take that example. So let's say you have someone with the balance sheet of $100 million and they're 65 years old. You could make the case that they have more than enough no matter what they did. And if they had 35 kids and grandkids, you could say, that's a lot of mouths to feed. I'm going to invest this pot of money a lot more aggressively because I'm not investing for my time horizon at 65. I'm investing for the grandkids who are going to be alive for the next 70 plus years. So in that case, you would lean into a more aggressive allocation. On the flip side, you might say, hell, I have no reason to take risk. I have more than enough. Despite my 30 kids and grandkids, I'm just going to keep this in a conservative investment to make sure that I have enough for their lifetimes and their grandkids' lifetimes. So you could frame it both ways. It really comes down then to investment personality and how much you're comfortable with, how much risk that you're comfortable taking. And that's a different answer for everybody.
Yeah, I think a nice compliment to this podcast was when we did previously all about risk, in that you have to look at the difference between your capacity to take on risk and your risk tolerance, because that speaks to two sides of the same coin.
So getting back to that article, which is in the Wall Street Journal, which I don't know if you can link that, Aaron, because it is behind a paywall, but I did not read it. But I could say The top two things that came to my mind when I saw that headline was people have PTSD from the bond market, right? Bonds are supposedly this safe haven asset. And for most of history, if you look back, every difficult market cycle, bonds have been a risk reducer in a portfolio. And the thinking is if equities go down, bonds are stable or even go up while providing some income. That did not happen last year. Bonds, in many cases, performed worse than equities, which really caused many investors to question the role of bonds in their portfolio. Now, I've wrote about this a lot. I think last year was more the exception rather than the rule for bonds. It turns out higher inflation and higher rates are bad for everything. It just happened to be that some of these longer duration bonds got really smashed, and they haven't come all the way back from where they were before the Fed started aggressively raising rates. Okay, so that's one thing. People tend to overweight what just happened. What just happened, bonds got crushed. The second thing is when someone is on a thin line between a successful retirement outcome and a potentially poor one, they tend to look to the financial markets to bail them out, right? Someone might be overspending, let's say. So let's say we have a $500,000 portfolio and you're spending, you're distributing $100,000 out of that portfolio each year, a withdrawal rate of 20%, clearly unsustainable. Okay. A misinformed investor might say, okay, a few of these years I've gotten away with it because my portfolio is up by 20, 25%. If I could just get that more often than not, it's going to cover up my leak on the distribution expense side. So we find investors reaching for risk, in this case, being more aggressive than they set out to, trying to get the financial markets to bail out a excessive spender, let's say. Those two things, the overweighting what just happened, squeezing out as much as you can out of the investment portfolio to cover up a leak. It's not a matter of if, it's a matter of when an allocation mistake like that is going to burn you.
So I know that you didn't get to read this article, but I'm going to give you the kind of opening lines that caught my attention. So
Okay.
This says nearly half of Vanguard 401k investors actively managing their money and over the age of 55 held more than 70% of their portfolios in stocks. In 2011, 38% did so. At Fidelity Investments, nearly 4 in 10 investors ages 65 to 69 hold about 2/3 or more of their portfolio in stocks. So 49% of retirees, early retirees, have 66% plus of their portfolio in stocks.
Well,
Does that surprise you or not surprise you?
No. So as you're reading that, another thing pops in my mind. You think back from, call it 2010, spring of 2009, up until 2022, equities have been the place to be, namely U.S. equities have been the place to be. So when I talk about the recency bias, it works for things that have done really well. People think they're going to continue to do well. And it works the other way. Things that have done really bad, people continue to think they will do bad. Like, I don't know what it is, but just to put a bow on that, the last 3 months, it's been no secret, REITs, right? A real estate investment trust investment has done poorly. That was true last year. It's kind of lagged the first half of this year. A lot of talk about commercial real estate and the stress there. I've had people come out of the woodwork telling me, when did we start investing in REITs and why do we own REITs? And it's a pattern as old as time. When something is out of favor, people think you should shun it. When something is in favor, they think you should throw money at it. And that's not how investing works at all. It's actually quite the opposite. Sure, you can change your risk exposures to certain areas that are in and out of favor, but pounding the table and saying you should sell something just because it hasn't done well the last year, that's just a wild misconception of how investing actually works.
Right. And that same REIT that people are complaining about this year and last year was up like 30% in 2021. And nobody was complaining about it then.
Right. And when you zoom out even further, like those asset class quilts that show you year by year what asset classes perform the best, I could be mistaken, but REITs are darn near at the top, if not at the top, over the last 10 to 12 years. So it's just there's so much human psychology packed into the way people speak about investing. And I think a lot of what we do through our blog and podcast is just dispelling a lot of the myth and the signal from the noise.
So there was quite a few quotes in this article from economists, retirees, just kind of giving their own 2 cents in how they feel. I'm going to read you a couple. Why don't you give me your feedback?
Okay.
So this one came from Robert Schiller. He is a Nobel Prize winning
I know
economist
who this man is.
at Yale University. He says, the spirit of the times is, quote, don't worry about the markets crashing. They will come back and set new highs. So that kind of speaks to the ride the waves. It will come back as long as you don't bail. You will come out on top, right?
So is he saying that as his own opinion, or is he speaking for these people that are invested more aggressively?
They don't really pull it out and bring it back to anything. So I'm assuming probably retirees that are invested more aggressively. It lacks a little context.
Can you say the quote again?
Yes. The spirit of the times is, quote, don't worry about the markets crashing. They will come back and set new highs, end quote.
You know, like zooming out, this quote triggers something in my mind. Like if you're going to err on one side, like I don't mind this whole premise of retirees being invested a little more aggressively. Like I think that's fine. If you're going to err on a side, I would err on the side of being an optimist. Like you look at 100 years of market data, sure, markets go down. That's part of investing. But erring on the side of being an optimist has worked out well for the U.S. investor. It's not true for every country. It's true in this country. So I don't mind that at all. And there has been a kind of a subculture or an animal spirit of buying the dip over the last 10 years. And to be fair, it's worked. And a lot of people want to assign value to that. Like, oh, buying the dip works. No, it's getting invested works. Like having excess savings that you don't need in the next 6 months and shoveling it into the market, irrespective of valuation, of market timing, of your opinion on what happens next, that works. Call it buy the dip, call it dollar cost averaging, call it whatever the hell you want to. The fact of the matter is, if you have long-term monies, don't overthink it. It usually works just to get it invested.
Okay, here's another one that came straight from a retiree out of Albuquerque, New Mexico. His name is Toby Bloom. He's 63, and he says that he tried investing 60% of his retirement savings in stocks and 40% in bonds, not an uncommon allocation for retirees. But 5 years ago, he realized his returns weren't high enough to achieve the goal of retiring by 2026 with at least $40,000. I'm assuming that that's $40,000 annually, not $40,000 in his whole retirement account.
$40,000 in annual income is probably what Tony's referring to.
Maybe, but this next sentence makes me think otherwise. But it says he moved 80% of his money into dividend paying and other stocks in his IRA, which now holds $21,000. That one's a little confusing, so maybe we cut this one out.
So he was basically saying he invested his nest egg in a portfolio of 60% stocks and 40% bonds. 5 years went by. He realized that wasn't enough. And to juice the return so it would be enough, he's investing in dividend-paying stocks with the majority of the portfolio. Is that what I'm capturing?
I believe so, but now the entire portfolio value has been almost cut in half, is what it sounds like. But 40,000 to 21,000, I'm a little bit confused about I'm not sure.
So Tony
what his
obviously
goals
has a
are there.
number in mind that he's trying to achieve.
Yeah.
Right? Like he has a retirement number in mind that he wants to achieve. I'd allude back to my earlier comments where he's looking for the market to bail him out. And I would focus on working longer, saving more, building a portfolio that reflects the way that he feels about risk. I could picture Mr. Tony looking at what's performed the best and shoveling money into those assets or stocks or what have you to try to squeeze out a return, which again doesn't end well. I think he's finding that out. But negative outcomes, again, are part of investing. A retiree's challenge is being hypersensitive of the risk that you're taking when you actually retire. We've talked about this a lot because think about the first day that you retire. Your assets have to last the longest period of time. So that next year, next 2 years, next 3 years, if you took a 40% drawdown on your retirement assets, that could adversely affect your plan. So when we talk about being honest with yourself, finding your investment personality, your risk profile. That's what we're talking about. Tony sounds like he's fishing without a pole, jumping from asset class to asset class, trying to chase performance, which it hasn't worked out for him.
Well, and two, it's also understanding the potential range of outcomes from the portfolio that you're building. He probably only looked at the upside of what 80% in stocks could give him and kind of discounted what the downside would potentially mean for him. Okay. Last but not least, let's talk about Stan Galperin.
Feels like we're on a radio show, like Stan's calling in and asking
Stan's
questions.
calling in. He's 80 and it says that he started trading stocks a few years after retiring from a career running video rental and grocery stores in southern New Jersey. In 2013, he moved to the Villages, a sprawling retirement community in Florida, and co-founded an investment club. He sold the bonds that had comprised 40% of his portfolio and began trading stocks. Interest rates were so low, this is what Stan says, interest rates were so low that it didn't pay to hold bonds. Now, interest rates have moved higher. He's moved more of his portfolio into money market accounts, and he continues to trade stocks. So you wrote about this recently, about how much cash is too much. So it sounds like rather than bonds, he has moved into money market accounts.
So this man is trading his entire retirement funds.
It sounds like it.
So that's problem number one that we should talk about. And we actually do something here that is pretty unique, I think, in that we encourage our clients to have a side trading account, a slush account, a express your active views account. The caveat is it should be with 10% or less of their investable assets. Mm-hmm. So we all have opinions, especially if you like to follow markets. Most people have companies they like, companies' products that they use, and they have some sort of opinion, and they want to express those opinions. That's great. Scratch your degenerative itch, day trade, buy speculative stuff till your heart's content. However, you should have the bulk, 90% or even more, in a stable, long-term, evidence-based, rational asset allocation that reflects the way you feel about risk, that fits with your financial plan. You know how much risk you're taking. You have a mechanism that's non-emotional to make buy, sell, and hold decisions. Okay. My recent blog that you alluded to on cash is fine for short-term monies or monies that's parked in your savings account that you want to squeeze some additional yield out of, right? That's great. Optimize that all day. That's low-hanging fruit. People have gone overboard with that, obviously. You look at money market levels, peak money market levels correspond with stock prices doing well. You know, the herd tends to be irrational and emotional. And I think people have gone a little too far with over allocating long-term money that would be invested in a long-term portfolio and parking it in cash. And lo and behold, I shared a chart during my last market commentary. When the one-year treasury yield hit 5%, that got a lot of press in the financial media. Okay, a lot of people were saying, hey, why the hell would I invest in stocks when I can get 5% on a one-year bond? Well, returns since that have been overwhelmingly in favor of equities. Equities have raced higher. Those safe 5% yields have returned like 1.5%. So that turned out, you know, people aren't keeping score, but we pay attention to these things. That turned out to be a disastrous trade in a silo. Mm-hmm. So to your friend, I don't know what his name is, but just balance out the urge to over allocate to cash with keeping the integrity of your long-term asset allocation. And make sure it's consistent with your risk profile. Like a lot of people are using this cash trade as pseudo market timing, right? I should be 70% stocks, but I'm going to go 40% stocks and 30% cash and wait how this plays out. That's essentially market timing, and that's what people are doing right now.
Yeah, it's a good way to get left behind. So one of the points that this article points out is that oftentimes retirees are over allocating into stocks because they feel that there is a lack of options for them. I think probably more so in the zero rate environment.
Yeah, no. And I've said this before, when a rational investor is making an asset allocation decision, it's not made in a silo, right? I'm comparing how stocks stack up with bonds, with cash, with real estate, with cryptocurrencies. Right. So you're looking at the opportunity set of investments, which these these relationships change over time. The attractiveness or unattractiveness of any of those asset classes changes over time. So you want to poke your head up, evaluate the landscape, and make a decision. One of the reasons why we over allocated to short-term treasuries last year was because rates were going up. Short-term bonds are less sensitive to rates going up. And we also wanted cash coming due. We always wanted money to be coming to us so we could poke our head up and make these asset allocation decisions. So it's important to have a framework to do all this. It can get a little confusing if you're just shooting from the hip or making emotional decisions or following the news cycle. And that's part of what we do at Pure is we strip emotion out of the investment process to help people make rational asset allocation decisions. Because I can tell you, when you're reading headlines, when you're watching the news, when you're reconciling what people are saying versus what's going on in the market and what's going on in the economy, oftentimes they can become jumbled, disjointed, and it's not a linear thing where if economy gets better, stocks get better. Economy gets worse, stocks get worse. These things can speak different languages at different times and throw people off.
So since this is kind of a topic of fixed income, a lot of people have questions now that they're kind of getting back into the fixed income space about bond ETFs.
Mm-hmm.
Can be difficult to understand, but give me the argument for using them in place of individual bonds.
Yeah, so this might go off the rails, but I'm going to give you a couple mental shortcuts, and then I'll tell you how we build things here and why. One, I think if your bond portion of your portfolio is less than $500,000, bond ETF all the way. It's just hard to be diversified with a smallish portfolio size. And I don't want to make it seem like a $500,000 bond portfolio is small, but you want to build a diversified basket of bonds. We only buy bonds in minimum lot sizes of 50,000. So 500,000, that would be 10 $50,000 bonds. All right. Like anything less than that, you're starting to take these large active bets in individual bonds, which, if one of those blows up, that means you don't get paid back. And that could severely impair your capital and affect your total return. Okay. So for small account sizes, ETFs are great.
Really quick before we move on to larger portfolios, break down what a diversified bond portfolio looks like, because I think a lot of people have gotten caught up in just US Treasuries.
Mm-hmm.
So what else would you add in to actually give someone the exposure that is really required?
So for a retirement account, right? So let's say a IRA account. I think you could have a basket of US Treasuries. That's kind of your solid, no credit risk, stable, risk-free asset class, right? I'm not a fan of taking a historically safe asset class like fixed income and over allocating to a risky asset class within fixed income, like a lower quality bond, right? I think those might have a place, but it's more of a satellite position. So core should be US Treasury. Then you can go, if you want to take a little more credit risk, maybe squeeze additional yield, you can go corporate bond. Again, core should be investment grade, high quality corporate bonds. Think Target, Walmart, Apple, stable companies like that. And all of these bonds will have a rating, a credit rating, triple, double A, single A. Usually anything above single A is investment grade. Anything below that, like triple B, would be like a marginal credit just below investment grade. Okay, so those two. And then if you want to get enterprising, squeeze yet a little more yield still, you can dabble in the high yield space, those can behave like stocks when things get bad. So those tend to have a wider range of outcomes. A lot of lower quality companies have variable rates, meaning they're always raising cash. And if rates go higher, their cost of capital goes up, which could put stress on the underlying business. So you want to be very intentional and mindful of what you own. And again, in general, not a fan of turning a safe asset class like fixed income into a risky one by reaching for yield or taking credit risk or buying 50-year bonds. I'm using an extreme example.
Okay, and then on the smaller portfolios, many people don't understand why 50,000 is kind of the target per bond. What are the risks associated with buying those smaller lots?
Well, the risk is you get crappy pricing. Like no one buys bonds in odd, like no one wakes up in the morning and says, oh, I want to buy a $1,000 lower quality bond today. Like those people don't deal in that. So when you're buying an
Mm-hmm.
individual bond, I would strongly encourage you to at least buy bonds in $50,000 lots because the pricing is better. I see client portfolio, like new clients transfer in here all the time, and their broker is buying them $5,000 lot bonds. And the reason why they do that is because they can hide the commission easily, right? So if I'm buying a $5,000 bond and I want to charge a 10% commission or $500, it's pretty easy. It's easier to hide that and charge $5,500 than if I want to charge a 10% commission in a $50,000 bond. That's going to stick out pretty, that's just going to stick out. A $5,000 commission, $50,000 bond, they're going to charge you 55 grand. Like, you're going to notice that. But if I do it, 10 bonds, $5,000 each, charge you $5,500 each, I can hide that easily. And that's what these brokers do all day. They're professional salespeople.
Great info. Okay. How about for the larger portfolio?
Larger portfolio, this is going to sound maybe a little funny, but for shorter maturity bonds, call it anywhere from 1 to 5 years, I want to buy an individual bond. That's a contract. I know exactly what I'm getting, know exactly what I own, when I'm getting paid, when I get the full amount at maturity. All right. For longer dated maturities, like if I want exposure to intermediate bond, call it 7 to 10 year, maybe even 15-year bonds, an ETF is preferred because in general, those longer maturities have interest rate risk and duration risk, meaning they move more when interest rates move and bond yields move. Okay. If it moves more, I want to be able to have a flexible approach. If the market moves against me, I want to be able to sell out of that position. Or if I want to add duration risk and I just want if I think rates are going to go down, like the Fed's probably rounding third base, potentially cutting rates at the start of 2024, I want to be able to capture that rate cut. My bond ETF goes up in value and then maybe pare back some of that. It's hard to do that with an individual bond because in general, when we buy an individual bond, we want to own it until it matures. So the longer duration, longer maturity bond ETFs allow us to be just a little more tactical on the fixed income side and reduce duration and interest rate risk when it's not favorable, or maybe even add it if we're expecting rates to go down, like we are probably in the next 6 months here.
Yeah, so bringing that back to how we reallocate, thinking about like October of last year, let's say in a balanced portfolio, we were like 65% in fixed income?
Yeah, that's fair. That's pretty close.
So say we had added to fixed income throughout the year using individual bonds. Now you've got maturities that you're waiting for till 2024, 2025 maybe. And now that markets have moved higher on the equity side, you'd be missing out on all of that had you locked in 3 or 4% last year. So I think
there's a few things there that you can do. So, I just used the short-term bond example, but for a lot of our fixed income portfolios, not only were we adding to fixed income last year, but we were laddering bond portfolios to always have money coming due. And I kind of talked about that. So like in our US Treasury portfolios, like we're not just buying 1 year US Treasuries, we're buying 3 month, 6 month, 9 month, and 1 year. And now what we're seeing is those funds are coming due and we're able to add to equities or to add to whatever asset classes our rules are telling us to. So we always want money coming due in any environment because it allows you to be flexible and to make asset allocation decisions. I was going to say something else and then I forgot.
Sorry, I probably cut you off.
No, it's all good.
I wanted to dive into that a little bit more because bonds are just confusing as all get out. I mean, nobody understands them. Even some of
professional advisors don't understand bonds. I find the bond market fascinating, and I've been dealing. I was buying individual bonds when I was like 24 years old, and I find the asset class fascinating. And I do think it's one of the areas a savvy advisor, a savvy professional investor can really add value to. And this week, okay, so this is what I was going to say. So this week, I'm writing a blog about when it's time to start repositioning a bond portfolio or money market fund for when rates actually go down. Like the playbook, it's not easy, but there's one playbook for when rates are going up. That's to, rates going up, inflation going up, there was few places to hide last year. One of the places to hide was the short-term treasuries. Again, less sensitive to rates going up, shorter maturity, you get your cash back, you can reinvest at higher rates. That's one playbook for when rates are going up. When rates are going down, completely different. And I think people are getting lazy in the fact that they think 5% money market yields are going to last forever. And they're not going to last forever. And what people are going to find out is when the Fed starts to cut rates, those money market yields almost go down 1-to-1. The Fed has very close control of the short end of the yield curve, meaning Fed funds rate at 5%, they cut down to 4.75%. Your money market yield is going to follow that cut, that reduced interest rate very closely, almost 1-to-1. The Fed has less control over the long end of the yield curve. And in general, when the Fed cuts Fed funds rates, those longer term yields, or if we get an economic event like a slowdown, like this recession everyone keeps talking about, long-term rates tend to go down, bond prices go up, and you can get kind of that extra juice from rates going down and bond yields going down with the appreciation of the bond. So I'm talking about the reinvestment risk, right? So there's a risk called reinvestment risk, meaning if I have a 5% yield today and I have $100,000 invested in a money market fund, right? In 1 year, let's say I get $5,000. $5,000 divided by 100 grand is a 5% return. Okay. Fast forward another year. Let's say my rate goes down to 3%. So money market rates are at 3%. Well, I'm getting that interest back and the new market rate is 3%. So everything in interest I'm getting back is going to be reinvested at a lower rate today. That's reinvestment risk. Okay, so what I'm going to be talking about are ways to mitigate that reinvestment risk by potentially, instead of keeping your money in that money market fund, buying a 3 or 4 or 5 year bond. Slightly lower interest rate today, but you're locking it in for a longer period of time.
You know, it's been so fun for me, just personally, is graduating college within the last 5 years. There are so many things that you learn that you don't get to see really play out in real life for sometimes a decade or two, you know? So there's all these, investments 101, econ 101 that are just kind of this theory that may potentially happen at some point in the future. And so much of that has happened in the last 3 years that it's just been not fun, but fun to watch play out in real time because you get to really put your knowledge to work.
No, I said this in the pandemic, but I think the pandemic, everything that followed the last 2.5 years, 3 years, I mean, they're going to have history classes and finance classes based upon this period of time. It's been truly unparalleled. And on one hand, it's been mentally and intellectually stimulating. On the other hand, it's been a little nerve-wracking because, like COVID, there wasn't really a playbook for that, right? We were all locked inside. Kids are at home doing school. And a lot of folks were making it up as they went. And it was a stressful time for a lot of people. And then on the other side, there's just a lot to the news cycle. And I talk about the news cycle a lot, but man, just the misinformation and the fear mongering and the pessimism. And it's been exhausting to dispel all of these myths and YouTube videos and narrative investing and hot takes, which they've all been wrong. Like Wall Street's never been more wrong the last 3 years than they ever have been. But just these people that keep saying the same nonsense and they're wrong and people don't know they're wrong, or they don't know they have an agenda or misaligned incentives. And it's just, that part of it is really exhausting. But now it sounds like I'm complaining. I'm not complaining. It's really a sign of the times. Like all of this is just an odd cocktail.
Oh gosh, don't go there. That's a whole other rabbit hole.
What, cocktail?
But, the sign of the times.
Oh.
But anyways, this episode was mainly for our retirees and those in the years leading up to retirement. We talked a lot about the risk that you're taking on, your allocation, what's appropriate for you, what's maybe not appropriate for you, and some alternatives and things to think about. So I think this is maybe informative for some, and I think that it will be a great complement to your blog that you're writing this week. So we were on the same wavelength.
Yeah, and if you want to learn more about our bond portfolio construction process or the way we think about fixed income, I'm happy to share as Aaron alluded to, bonds are really confusing, the most complex asset class on the planet. Most professional advisors don't understand them. That is readily apparent to me based on the new clients that we have coming in when I look at their fixed income portfolios and have to unwind them. So if you want help or want a second opinion, even if you work with another advisor, we're happy to take a look. We're not salespeople. We'll give you advice. We'll give you information. You can do that as you please.
Okay. Thanks for listening to this episode of Blind Spots. We will see you in the next one.